Look, you probably think you know exactly what caused the 1997 Asian financial crisis, right? A sudden economic shock, a massive currency collapse, basically an unpredictable accident. Well, the world was completely wrong. Today in this explainer, we're ripping off the mask. We are diving into a deep forensic investigation that proves the Korean economy wasn't murdered by outside forces at all. Nope, it was actually hollowed out from the very inside. And this started way before the crash ever happened.
396%. Let that sink in. That was the average debt-to-equity ratio of Korean firms right before the 1997 crash hit. I mean, that is absolute financial suicide. Just to give you some perspective here, at that exact same time, the US was sitting around 154%. Taiwan was way down at 86%. So Korean firms weren't just borrowing money, they were literally drowning in it. But here's the crazy part. The real crime wasn't actually the debt itself. It was what they decided to do with it.
Okay, get ready for a massive face slap of reality. For almost an entire decade before the crash actually happened, the cost of borrowing money completely eclipsed the ordinary profits these companies were making. Just think about that for a second. Every single dollar these firms borrowed actually made them bleed cash faster. They were literally paying more in interest than they were bringing in as income. So this wasn't some sudden economic heart attack. No way. This was terminal, stage 4 corporate cancer that had been growing for years.
So that brings us to our first main question. Who exactly hollowed out these Korean firms? Let's take a look inside the boardrooms.
The whole secret lies in this incredibly deadly corporate structure. It's all about the massive gap between two things: cash flow rights and control rights. Now, cash flow rights, that's just what you actually own. Control rights are what you get to boss around. In a normal, healthy company, these two things match up. But in Korea, oh, it was a totally different story. The bosses were essentially playing God with other people's money. They were risking almost nothing of their own, but controlling absolutely everything.
Let me introduce you to the chaebols. These were the mighty, massive conglomerates that completely dominated Korea. You'd think the founding families owned the whole pie, right? Actually, the founding families of the top 70 largest firms owned a pretty pathetic 9.9% of the asset-weighted shares. Less than 10%. They were essentially ruling an entire nation's economy using pocket change.
So how exactly do you build a massive empire with basically nothing? Well, you exploit the system. First, you scatter the shares among millions of powerless, everyday people so no one can challenge you. Second, you exploit something called shadow voting. This was this crazy legal loophole that forced major banks to cast neutral votes, which essentially silenced them completely. And third, you build these insane pyramidal cross-holdings. Basically, Firm A owns Firm B owns Firm C, and the founding family just sits right at the very top of it all. It was a perfectly legal house of cards.
Moving on to part 2, the complete shattering of the chaebol myth. Were these massive giants actually safer?
We've all been told that massive conglomerates are just too big to fail, right? That size naturally brings efficiency. Well, the data we're looking at violently destroys that myth. Turns out, independent firms completely crushed the massive chaebol affiliates when it came to profitability. Being a giant didn't make you safe at all. It actually just made you a bloated, bleeding dinosaur. The mighty chaebols, the ones everyone thought were invincible, were literally the absolute worst performers in the room.
So why did these giants fail so miserably? It comes down to the illusion of the internal capital market. Look, in theory, massive groups are supposed to move money around efficiently from one department to another. But in reality, they just created these massive bureaucratic monsters. They routinely overinvested their capital into weak, dying divisions and totally starved their strong, profitable ones. They were literally killing their winners just to feed their losers. It was an absolute masterclass in wealth destruction.
All right, Section 3. Let's look at the merciless face slap of hard data. It's time for the forensic audit.
Now, I want to be clear. This isn't just some abstract academic theory. What we are exploring in this explainer is a massive forensic audit of over 5,800 Korean firms. We're talking about a complete 5-year timeline leading right up to that 1997 crash. And the crucial weapon used in this investigation: raw, outside audited accounting data. No guesses, no estimates, no stock market noise. Just the cold, hard, bleeding numbers pulled straight from their actual financial statements.
And this data exposes a massive, glaring flaw in a lot of previous research. See, other studies tried to measure this crisis by looking at stock prices. But the Korean stock market at the time was incredibly inefficient and honestly mostly just panicked. Stock prices during a crash are basically just noise.
But as the researcher here, Sungwook Jo, proved, accounting profitability is the absolute only true measure of a company's survivability. By completely bypassing the stock market illusion, this raw data finally exposed the true heart of the corporate cancer.
So the final verdict? It's actually devastatingly simple. Lower family ownership equals lower firm profitability. Period. Basically, when the boss doesn't actually own a large piece of the pie, the company just bleeds money. The data prove this conclusively across thousands of different firms. The less of their own money these bosses risked, the more wealth they completely destroyed.
That leads us straight into Section 4, the fatal black hole of capital. Let's trace how they actually move the money.
You might be wondering, how exactly do controlling minorities steal from their very own mighty companies? Well, they don't just set the money on fire. They do something called tunneling. Here is the playbook. Step 1. They borrow massive amounts of cash using the pristine, clean reputation of one of their healthy subsidiaries. Step 2. They secretly funnel those resources directly into a weak subsidiary that is heavily owned by the family. And Step 3. The wealth of the regular, everyday minority shareholders just vanishes into thin air. It is literally a parasite draining the host.
So, where did all those borrowed assets actually end up going? Spoiler alert, it was not into building better products. A staggering 13% of those assets were just dumped right into non-production investments. And another 4% was shoved directly into the financial securities of their own affiliated firms. We are talking about massive chunks of capital just being funneled away into these wildly inefficient intragroup financial black holes.
And finally, Section 5, the ultimate alarm of crisis. Let's talk about the lessons for us today. The whole macro shock myth, it's officially dead. The 1997 crisis was absolutely not a sudden, unpredictable accident. That external economic shock was really just a strong gust of wind, and it pushed over a completely rotten tree. What we saw was the totally inevitable collapse of a hollowed-out shell. It was destroyed from the inside out by incredibly toxic corporate governance.
Which leaves us with a pretty chilling reality, doesn't it? The 1997 crisis was triggered by hidden corporate parasites playing God with other people's money. They were controlling massive empires with single-digit ownership stakes. So, you have to ask yourself, do you know the real gap between cash flow rights and control rights in the companies you invest in today? Who actually controls the stock sitting in your portfolio right now? Take a closer look. You really might not like what you find.